Howdy. In this video, we want to talk about how to roll a covered call. Now, this is a pretty simple trade. It's something that it's pretty easy to do and that you would do pretty commonly, especially if you're a covered call trader. But for new people, it's something that they're a bit confused about, and it can be a little bit complicated in terms of the different options that you have while you're thinking about rolling. Do you roll? Do you not roll? Where do you roll? How far do you roll? There are different things that you need to think about. So I found myself in this situation right now. I have a covered call that I'm thinking about rolling. So I figured, hey, let me use it as an example and give you the real numbers. So these are real breakdown numbers that I'm facing this decision right now. And I can give you exactly, the exact situation and exactly what are my options along with the prices. So it's a pretty good scenario here. So basically the stock that I have is LVS. My average price, and I have multiple shares, so I don't know exactly the price for the 100 shares that we're talking about here, but my average price is $43. Currently, the stock today, as I'm speaking, is trading at 51.70, so that's the price we're going to use in this scenario. And what I have done is I have sold the 50 strike call. I've sold one. We did many, but for this example, we're going to use one. I've sold a 50 strike call, and that was sold when LVS was trading below 50, and I got 98 cents for that. So for one call, that's 98 cents, but that's actually 100 shares, so I got $98 as a credit. Now today, there's 9 days left to expiration. So in the past, LVS has been trending. Actually, it has been channeling, not trending, sorry. It's been going up to about the 50th strike, 50.49, $50, and then it has fallen back. But this time, it has broken out of that channel and has continued to go higher. They had earnings, I believe, a week ago, and they had decent earnings. So LVS has broken the channel. It has going high. It is going higher, and it looks like it's going to go a little bit higher before it comes back. So now I sold the 50 strike call because I thought that if I can get out at 50, that'd be a good price. That would be at the high end of the range, and then when it comes back down to the bottom end of the range, then I'll buy it again. And I've been doing that in this stock for a while now. Waiting for it to go up, selling some, waiting for it to go down, buying it back, then selling it at the high, then buying back at the low. And I've been playing around with this for a while. So it's been very profitable, and that's why my average price is $43. And so what we can do here is I would like to keep the stock. I would like to keep the stock, but I really want to look at what all my choices are, what all my options are, and if I have to let it go, I can let it go. But I think in my head, I'm thinking that LVS is going to go higher. I have a nice gain, so I might take the gain. I haven't really decided exactly, but I was thinking originally, and this is a common problem with covered calls. I was thinking that if the stock gets to 50, I'd be very happy selling it at 50, taking some money for the covered call, and I'll be happy. But now that I see the stock is approaching $52, I'm thinking, wow, that's an extra $200 that I'm leaving on the table, and the stock might actually go higher. It might go to 55, so that's a lot more money I'm leaving on the table. Maybe I'm going to get greedy and I want to stay in the trade. But then, of course, if LVS drops back down, then I'm going to get upset again and kick myself for not getting out. But that's the name of the game. So basically, this is on the screen. This is what the breakdown scenario is. And now let's go ahead and look through the different choices that I have laid out. So the first thing I can do is nothing. If I do nothing, the stock is going to get called away, most likely. We do have 9 days left. And so if the stock gets called away, I'm going to be paid $50 for my 100 shares, and my profit on those 100 shares is going to be $798. That's broken out into the $50 that I get for the shares. And I paid, my cost was, if you remember, my cost was $43 a share. And then I also got an additional 98 cents per share for the call, for selling the call. So it's $50 minus $43 plus 98 cents each times 100 shares equals $798. Now, you really want to determine if you want to take this money or not. That's up to you as an individual trader. How long you've been in the trade. Also, if I had this stock for the past 10 years, then that's not a very good return. If I had the stock for a week, that would be a pretty swell return. And then you have to decide what the stock is going to do. Can you make more? Can you make less? That's the name of the game. Or do you want to just get out? Do you want to take that money that you're tying up in 100 shares of this stock and move it into something else that might be going up higher, faster? Maybe you want to put into a really high flying name like an Apple that seems to be going up every day lately. And get it out of this stock if this money has been dead for a while. So that's one option. That's choice number one. I can do nothing, get called, my stock goes away, and then I get $798. If I'm thinking that this is the high of the channel and LBS is going to retreat and go back down, then this would be the perfect scenario. And a lot of people who trade covered calls just for income would rather do this. They just want to do a covered call, get paid their 2-3% a month or whatever they're making, and then move on to the next one. So this is choice number one, do nothing. Choice number two, what I can do is I can buy back the call. Okay, and I'm not going to stay in this trade, but this is buying back the call. So instead of getting called away, I can simply buy the call back, and currently the call is trading for $2.15. So it's going to cost me $215 to buy this call back, and as you can see, I paid $98 for it. So I'm actually going to be coming out of my pocket $117 for this call to buy it back, because I already got $98 for it. It's going to cost $215, so I need to come up with an additional $117. Now the thing is, the stock is trading at 51.70. So if the other option number one was just to let the stock go at 50. But if I don't do that, if I buy my call back and then I sell the stock at 51.70, which is what it's trading at, then I get an extra $170. Because I could either, if I don't let it go at 50, I let it go at 51.70, that's another $170 in my pocket. So $170 I can make, but it's going to cost me $117, so I make an extra $53. So obviously, if you are happy with letting the stock go, if I'm happy with letting it get called, then this might be the better move. Because I get an extra $53 for doing nothing, just buying back the call and selling the stock right away, and I'd be out of the trade today. I don't even have to wait till expiration. So now the question is, why is this? Why am I getting an extra $53? Well, part of it is because time decay. The option still has 9 days of time decay, and there is still the chance of the stock moving up and down, and in this case probably moving down, in which case the market makers are giving me an extra $53 in this trade to do it, because there's a chance that it could go down. So if I want to get out, if I'm happy with it, then I would look at this and say, okay, let's do this. So a lot of you guys that are covered call traders, you might just be happy letting the call get assigned. But you might want to take a look at this option as well. So this is choice number two, buying back your call and selling the stock right away. And you might come out ahead. Now, of course, this $53 is before commissions. All these numbers are before commissions. I haven't added commissions to these numbers. So, but your commission is probably going to be around $4 or $5, depending where you are. You're selling stocks, so if you're at Scott Trade or something like that, you're paying $7, $8, whatever you're paying. That'll lower your profit a little bit. But still, you're making some extra money. Now, let's go on to choice number three, which is rolling the call. So this option, and we're actually going to get to another rule, but this rule is keeping the same strike. So if I roll to the next month and I want to keep the same strike, what I do is I buy back the call at the 50 strike call, and then I sell another 50 strike call on the next month. So with 9 days left, the next month is running around 35 days, 37 days, I believe, to expiration. So I have to stay in the trade for, an extra 30 days, an extra month. But let's see what this does. Currently, the next month call is selling for $3.15. So I can buy back the current call, this month's call, for $215, and then I could sell next month's call for $315, and I'll get an extra $100 credit. Now, this means that I have to hold the stock for another 100 days, for another 30 days, and then I have to figure out what's the return, how much money is tied up in this stock, and if I get an extra $100, is that a decent return to hold on to it for 30 days, thinking that, hey, the stock might drop. But if I do think that the stock eventually is going to drop, and I want to hold the stock, and I think that I'm just needing some more time, it's going to drop. It won't drop this week, it'll drop next week. Maybe there's some news coming out or something going on, and I think that the stock is going to drop next week, and I want to hold on to the stock, then this would be a good way to stay in the trade and get paid for it as well. So I keep my shares. Maybe there's a dividend coming up that you want, or something in that effect. You keep the stock, and you actually get paid for holding it, and then you're still in the trade. The downside is that if LVS continues to go up, if it goes up from 51.70 where it is now to next month where it gets to maybe 55, 57, or 60, who knows where it's going to go, then you miss out on all that upside. So that is the case with rolling this call. Now, if you're going to roll this call from here to the next month, you'll notice that if we buy it back, we're paying $215, even though the stock is only $1.70 above the price. So on expiration day, if the stock price is still $51.70, then this call should be worth $1.70. Should not be worth more than that, but it is worth $215 because of that extra time that's still in there. That 9 days is what's boosting up this price. So if you're thinking about rolling the call, and if you're not very far in the money, then you would want to wait as close as you can get to expiration so that the value of the call goes down as much as possible, and then you can just roll it out so you don't have to pay for a lot of time to get. Now, if it is a lot, if your sole call is in the money, then you do have a chance. The closer you get to expiration, the closer you get to early assignment. You have that risk of early assignment, which is rare, but it doesn't happen, and it normally happens at a couple of days or less to expiration when it's far in the money. If you're only in the money by $1, you probably will not get early assigned, and you can do this trade. Okay, now let's go on to choice number 4. Now here, we're going to roll the call to a higher strike. And why would I do this? So I'm going to do this because I'm thinking that I want to hold the stock because I think the stock is going higher. And I don't want to just let it go for $50. I want more money. So what I can do in the scenario that I picked here is that I'm buying the call back, the 50 call back, and then I'm going to sell a 55 strike call in the next month. So the 55 call for the following month is selling for 87 cents. So I'm going to have to come out. I'm going to have to come out with some money out of my pocket. And actually, this is incorrect. This should not be a credit. This should be a debit, because I'm actually going to pay for this. So I'm buying back the 50 call of this month for $215. And then I'm going to sell the next call for $87. So I'm going to pay $128. Let me make sure that's correct. Yeah, so I'm paying $128 for this trade. It's going to cost me $128. But next month, if I'm sitting next month and the stock is at $55 or above, and I get called at $55, then the stock makes me an extra $500. So instead of letting it go at instead of letting the stock go at $50, I let the stock go at $55. I make an extra $500 in the trade, and it cost me $128. So I can do the trade for $128, and I can make $500. So the profit on that would be $372. So I can make an extra $372 by rolling this 50 strike call for this month up to 55 next month, and assuming that the stock goes above 55 and I get called away at 55 next month. Now, next month, if the stock goes back down, or if it stays at $51.70, or if it stays at $50 or $51, then I still have to pay for the roll, but I'm not going to get that extra money because I can't sell it at $55. Now, this would be a good bet to make if I was thinking that I want to keep the stock. Now, normally when you do a roll, you want to roll it and you want to get a credit. You don't want to pay a debit like I'm paying here. The reason why I'm paying a debit is because my call is already in the money. If LVS was at $49, trading at $49, and I was trying to roll a 50 call, then I might get it might be a credit, if I roll it to the 55, or if there was more time left in the trade, or less time in this month. So the call, selling it for $87 is probably the price is going to stay about the same as the next couple of days go by, but my 215 that I have to buy it for, the 50 strike call that I'm buying it back for 215, that might go down in value as the time decay comes out. So again, as the time decay comes down, time decay takes out the value. This will go down to, say, $170 if LVS is trading at 51.70. Then my debit on the trade would be a lot less. I hope that makes sense. I hope I explained it properly. So these are the 4 options. Okay, option 1 is do nothing, get assigned or get called. Get the stock called, and I'll make $798. And for this to happen, I don't have to do anything. I just have to sit back and relax, and hopefully the stock in the next 9 days on expiration day is above $50, and I get my $798. It doesn't matter if the stock goes to 100. I still get this amount of money. Option number 2, buying back the call and then selling the stock today. I'll get an extra $53 above what I made on just getting called for it. So actually, let's see here. Okay, because I added the $98 here. Okay, so hold on a second. There's something interesting here. If we do option number 1, I got the $98 included in here. We get $798. If I do option number 2, the $98 is included in here as well, so you don't get, it's not $53 in extra profit. It's actually going to be a little bit less, because I'm counting in the $98. But regardless, this is one option. Okay, I haven't done the math, and I missed it. I apologize for the error in the math, but this is another option that you can do. And then choice number 3 is to actually roll the call. So you can roll the call to the same strike in the next month. You get a little bit of a credit for it, and then you stay in the same trade for another 30 days. Or you can roll to a higher strike call. Now, most of the time when I'm trading, this is what I end up doing, but I like to do it before if I want to keep the stock. So for, let's say for tax reasons, I need to keep the stock, then I can do this. So you got 4 different choices. And now, I'm currently in this situation. I'm not sure what I'm going to do. So now, taking a look at these four choices, I don't know. I think most likely I'll just let it do a little combination of each. Since I have more than 100 shares, I'm going to let some of them get assigned, and then I'm going to roll some of them to the 55 for next month. So even though it's going to cost me a little money to roll them, I do believe LVS is going higher, and I can probably get more money for it. So I'm going to roll it higher, and then hopefully it goes to 55 or higher next month, so I can let those get assigned. And then eventually I would like the stock to pull back some, so that it can give me a chance to get back in. In the past, $49 and $50 was the resistance level. It has broken through that, and so the technical analysts will tell you that it'll break through that, and then it'll come back, and it has to do a retest, meaning that it has to come back down to that old resistance level, which is now a support level, and then bounce off of that level and then go higher. So most likely LVS which is at right now at 5170, is going to come back down and hit 50 or 49. And then it's going to do one of two things. It's either going to keep going lower, or it's going to bounce and go higher. In either event, if it does start to bounce and go higher, then I'm going to buy some more shares at that time. And if it looks like it's going to go lower, then what I'll do is I'll just go ahead and sell those shares and then exit the 55 calls at that time. Or even just just let them run and let them expire. Because then I don't have to worry about it. If the stock is well below 55, these will just expire. Okay, so I hope this cleared up some stuff for you. If you're interested in covered calls and you're confused as to about if you should roll or not, if you have any questions, feel free to email me, and I'll hope to answer them as soon as possible. Thanks. Have a great day.